We do have a lot to talk about, Jesse, so let's get rolling. Today is October 3rd on about 5:30 in the evening. I'm Joe Terril, president of Terril and Company, Independent Wealth Managers in St. Louis, Missouri. This is one of our updates to our thoughts on the latest events in the economy. Working the cameras and helping me as always is Jesse Baker. And Jesse, we'll get going. It's a good time of the year here in early October because the Cardinals are in the baseball playoffs, as they always are, and we'll be rooting for them, besides obviously hoping that we have our portfolios positioned correctly for the markets. So let's get started.
Sounds good.
Since our last video, one of the issues that dominated perhaps the economy as well as investment markets was the threat that the Obama administration was going to bomb Syria and perhaps expand some of the issues we're already involved in the Middle East. And thankfully, throwing in that editorial opinion, maybe foreigners and the president of Russia talked him out of that, and we forgot about that. Therefore, the markets seemed to calm down, be very pleased that that was not going to happen, and begin to rally. The second thing that has come up here is obviously, for anybody that's been watching the news in the last few days, it's the issues in Washington. Will we extend the debt ceiling limit? Will we shut down the government, which has already happened? How long is that going to go on? Is that a major drawback to the economy? And what perhaps does this mean in Washington as both sides of the aisle, Republicans and Democrats, argue over Obamacare, etc.? The point of this, which doesn't seem to get framed in the media in a very good scenario, is I think what this real argument should be about, and is maybe about, although it's not being communicated properly, is what are we going to do about the budget deficit? And what are we going to do about the fact that the accumulated national debt of the country is now $17 trillion. The Obamacare Act was passed on a very partisan basis by Congress, and everyone was told, just vote for it, don't worry about reading it, and projections are it's going to cost $700 billion. Well, now we find out it's going to cost $3 trillion. So I personally believe it is absolutely the correct time to discuss this issue, because if we don't do something about this pretty soon, we're going to bury the young people of this country in debt to such a level that we will default. There'll be no way we're going to be able to pay the interest alone on the debt if interest rates go back up in perhaps 10 years if we continue at this pace. And adding this program, it's not the idea that trying to give everybody health care isn't a noble thing to do. It's that we can't afford it and we don't have any way to pay for it. This is the real issue. So short term, what do I think these politicians are going to do? They're going to argue and they're going to fuss around, and they'll come up some way to paper the thing over and continue to extend this. But it's a very dangerous proposition to continue to pile on programs that continues to run the debt. Jesse, you're much younger than I, and I feel sorry for your generation. You can run numbers out 10 years, 12 years, and there's no way you'll be able to even begin to pay as a citizen, to pay even the interest on the debt. So while there's arguments in the news media and people talk about this as if, oh my gosh, we can't default on the debt, and that's so important. Yeah, but they're not talking about it. They just want to continue to go on and say, well, let's pay the debt right now. But this is the issue. You've got to figure out a way to stop the spending. You won't be able to afford it. So while they carry on about how devastating it would be if we default on the debt now, they seem to be more than willing to pile on trillions of dollars of additional debt so we default later. What difference does that make? Let's have the argument right now. As it relates to investments, if they come to some type of conclusion that's even reasonable, the markets will get through it, the economy will get through it. But there's no question that if they don't do something, as each year goes by, this becomes a ticking time bomb and it becomes more and more of an issue. So for the moment, myself, the company, our investments, we're waiting to see what Washington's going to do. Are they in any way going to make any serious effort to rein in spending? Are they just going to continue to pile on more and more debt, hope that the foreigners will finance our debt and therefore we'll be able to handle it? I don't know. We'll see what they're going to do, and we ought to know in the next couple of weeks, and then we'll decide if there needs to be any changes to investment portfolios. But it is indeed a longer range problem that we're extremely worried about. Okay, the other issue that we need to talk about is the Federal Reserve Bank. The Federal Reserve Bank of the United States, in conjunction with other central bankers around the world, has been buying U.S. Treasury bonds, artificially keeping interest rates low. Interest rates are not at a level that seems to be the equilibrium level where lenders are willing to lend and borrowers are willing to borrow. It's an artificial rate being set by the government because the government is buying all the bonds. They're buying the bonds with printed money. They're buying the bonds with created money out of thin air. This could, down the line, be incredibly inflationary. Ben Bernanke, as governor of the Federal Reserve Bank, believes that he will be able to reverse the process if this gets out of line. Well, he's going to be out of office in January. We don't know for sure who's going to be in. Larry Summers was the front runner now. The liberal Democrats in the Senate don't want him, think he's too conservative. So he's not going to accept the job. Janet Yellen may be in. I think she would do a good job, but there could be some other contenders. But in the meantime, early in September at the recent Fed meeting, the Federal Reserve Bank said we're not going to stop buying the $85 billion in bonds that we've been buying every month. I know we told you in June, this is the way the Fed put it, that we were going to taper and we were going to slow down buying bonds, but now we decided we're not going to slow down buying bonds. This is a big issue. This is more important in the long term than what these people in Washington, D.C. are doing and the silliness of some of the arguments that they're making in Washington. This is a big issue. The Fed must stop printing artificial money and having an economy that's predicated upon artificial interest rates. So we have been, as anybody that follows what we've written or any speeches that I've given or even some of our previous videos know, we've been talking about interest rates are going to go higher, interest rates are going to go higher. And indeed, up until about 3 weeks ago, they were going higher. But now the Fed has changed course very abruptly and said, we're going to try and keep them down. This is worrisome to us. How are they going to continue day after day, month after month to continue up this pace? I don't know, and it's worrisome. So put that together, and we have several issues here that we really need to watch. We need to see if the politicians in Washington have any intention of doing anything credible about the mounting debt of this country, and we also need to see if the Fed has any credible evidence that somewhere in the very near future they're going to stop printing money and creating an artificial interest rate environment, which is very disruptive to the economy and certainly very disruptive to the ability of people to make plans when they have no idea what the Fed's going to do and how fast interest rates may move one way or the other. So we'll try and come back, maybe, Jesse, we should do another video in as little as 2 to 3 weeks when we see how some of these things play out. Separate from that, we think the stock market is reasonably priced. We're not a major seller of stocks simply because they're not overpriced, and we continue to see foreigners willing to buy shares in companies domiciled in the United States that are doing business all over the world. But we do have a couple of issues here, as you can tell maybe by the tone of my voice in this video, that I think are extremely important, and we're going to have to see how this plays out and whether this is going to create a long-term change in our thinking. So Jesse, as far as the current topics, let's stop there and we'll sum it up. So Jesse, as always, thank you for your help, and hopefully in 2 to 3 weeks we'll be talking about the Cardinals in the World Series and making a comment or two about how they're going to do, hopefully. But this has been Joe Terril. We thank you for viewing our videos, and certainly thank all of our clients, and thank you for the referrals that we continue to receive. And today has been October 3rd, and we will be back in 2 or 3 weeks with an update. I'm Joe Terril, president of Terril & Company, independent wealth managers in St. Louis, Missouri, with about $650 million of discretionary money under management. Jesse, we'll see you in 2 to 3 weeks.
Sounds good. I look forward to it.